Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. Today is Thursday, May 28th, and I thought I'd come to you with a brief update on the market as well as a little bit of a deep dive into the fixed income markets, which we don't spend enough time talking about around here. So anyway, the S&P 500 as I speak is about 3,057, which is up about 60 basis points on the day, and that's a very impressive rally off the bottom. We get our number one client question right now revolves around how is it possible that the S&P 500 is this high when the economic data that I'm seeing is as bad as it is in terms of overall unemployment. And I think what you're really seeing is a graphic illustration of the fact that the market is a forward-looking indicator of economic activity, not a coincidence or even backward-looking indicator of economic activity. So said differently, the market is looking out 9 or 12 months and thinking about the fact that there's a ton of stimulus out there, thinking about the fact that the news on the treatment and vaccine front has been generally positive, thinking about the fact that just today Dr. Fauci came out and said that a vaccine might very well be a November or December of 2020 event. And factoring all that into an expectation of where economic activity is in sort of the first or second quarter of 2021, as opposed to where it is today. So that's the general explanation behind it. I wanted to turn briefly to the fixed income markets, where we've seen investment grade yields drop from a pre-crisis of about 2.4%. Down to about 1.4% today. So, and that's measured as the Lehman Barclays Ag, and the yield on that number, the Lehman Barclays Ag is an index of pretty much all investment grade securities, plus a little bit of high yield securities. And the yield on that has obviously dropped by about 100 basis points or 1% down to 1.4%. And that's not abnormal. We would expect to see the yields on fixed income securities, particularly safe fixed income securities, fall when we see a little bit of panic in the marketplace. And so seeing those yields drop from 2.4 to 1.4 is actually exactly what we'd expect. We've also seen a significant amount of fallen angels. Now, what is a fallen angel? A fallen angel is a poetic term for companies whose debt falls from investment grade into high yield. So there are three different rating agencies out there: Moody's, S&P, and Fitch, and they all rate securities based on their credit quality. And when two of those three agencies drop their ratings to the equivalent of a BBB minus, then the security is no longer investment grade. It drops from the investment grade indices into the high yield indices. And this has a number of implications. When that happens, the security in itself is called a fallen angel, which once again I find a little bit poetic. But the second thing is that there are a lot of investment grade ETFs and mutual funds that then need to sell that security, and a lot of high yield vehicles that need to buy that security. Typically in a given year, we might see $20-30 billion worth of fallen angels, just as part of the normal corporate credit cycle. This year, we've seen about $161 billion year to date of corporate debt securities that have moved from investment grade down into high yield. That's actually the largest number on record, although it's not that surprising. We saw more than $100 billion in fallen angels back in 2002, around the 2002-01 recession. We saw it again in 2005 with that mid-cycle correction. Saw it again in 2009, as well as in 2015. In 2009, we saw about $140 billion in total of fallen angels. And as a percentage of the overall high yield marketplace, it was actually higher back then at about 16.5% versus where we stand today at about 13.5% for the amount of fallen angels we've seen in the current cycle. Why does this matter? Well, there's some price action that happens. So if you're an investment grade manager, particularly if you're a core plus investment grade manager, and maybe you were dabbling in some of these riskier investment grade securities, once they fall into high yield land, you can no longer own them. So you are now a forced seller. And meanwhile, the high yield market is a forced buyer of those securities. They have to step in and provide liquidity, particularly if you're an ETF. An active manager may not have to purchase it, but they may step in to purchase it. And so you've seen a little bit of disruption in the investment grade space as you've seen that amount of paper move out of investment grade and into high yield, and a little bit of disruption on the high yield side as well. I think what's a little concerning is that there's about $1 trillion of paper that is currently what I will call cuspy. So that's paper that's rated triple B by all three agencies, with with credit watch negative on at least one of those agencies. In other words, these are securities that are on the borderline between investment grade and high yield. And given that the entire size of the high yield market is only $1.6 trillion, saying that you have that amount of money that's on the sidelines of potentially moving into high yield presents a little bit of concern in the high yield market. So you've seen prices in high yield rally off the lows. They got to a low of about 80, in the high 70s in this cycle, and have since bounced back up to about the high 80s. They still remain a little bit depressed, but the prices look nowhere near as bad as what we saw in the 2009 cycle, where they bottom ticked at 60 and really took years to start to recover that price point. So high yield market still functioning normally. Yields are a little bit elevated, but in a good spot. So with that, I appreciate you guys letting me dive through fixed income land. It is certainly an interesting spot this time around. And it's a place where we've been doing a lot of work on the investment side to just make sure that we're adequately positioned. So with that, if you have any questions, please reach out to me or to your advisor. And I hope you have a great weekend and look forward to talking to you soon.